Happy Liberation Day, everyone. I hope you're feeling just as liberated as I am, and I hope that you've been able to take some time and reconnect with your loved ones, maybe sneak away for a short cry, or at the very least, find some calming sense of closure at the end of what has been a very long, very arduous, and drawn out tariff season and start to 2025. Now, we're using this new format here just as a subtle reminder that we do have an AI uprising on the side that is gaining adoption and changing the way we do things, and that should be a longer term positive for the markets. But it's not the focus for today. The focus for today is Liberation Day, the day when Donald J. Trump would finally come out onto the White House lawn and hit that big red shiny tariff button. It had been teased out for months. Market reception had initially not been very good, but we'd had this lead up and some green on the board of recovery that had led us to believe that perhaps the plan for a tariff rollout would be a little bit more targeted, not as widespread, perhaps just isolating some sectors and some countries that presented themselves as competitors and would therefore give the US a trade and economic edge. That was the market reception that we were hoping for. And I'm not sure that the rollout we got on tariff policy necessarily reflected that level of precision. So what did we get? Well, we got 10% across the board, broad rollout for a whole list of nations, and I do use the word nations very loosely. We'll come back to that very shortly. But the more damaging and the more market-moving reciprocal tariff was the one that caught attention. So what is a reciprocal tariff, you may ask? It's not retaliatory. That's what we've been dealing with so far, where the US puts in a tariff and then the corresponding nation says, I see that and raise. This is a whole other measure. And it's a position of your trade position with the US, your deficit, if you will, how much you're exporting to the US. So you take the deficit, divide it by how much you're exporting, and then you take that and divide it by 2. That part I'm still actually struggling with. The 2 I get, the 2 I understand, because then you get to come back afterwards and say, listen, I'm only doing about half as much in tariffs as I should be doing by this other metric. The other metric, though, is a reflection of your trade position with the states. It doesn't necessarily translate into what you're doing for economic growth. Different trade positions work different for economic models across the board. You know, the US should not run the same position as Canada, should not run the same position as China. We'll come back to that because the 10% rollout by itself is having some funny and unintended consequences all of its own. We got to start with the penguin tax. There was no way we were not going to be able to cover the penguin tax today. So this is the subarctic region, the Heard Islands, population 0. There is a large population of penguins, though, that will now be facing a 10% tariff after having ripped off the American consumer for far too long, in my opinion. Expect mackerel futures to soar. The other unintended consequence was the French territory of Saint-Pierre and Miquelon, which I know I just butchered. Archambault as a last name is complete French, false advertising, not French advertising. But they are a population of 5,000. They are facing a tariff of 50%. And I did have to look up, after seeing the first example here, what were the top exports. It does happen to be sea crustaceans, mollusks, and fish. So if there's one thing that is being made clear, it's that the White House has sea mammals, sea creatures firmly in their crosshairs, and the market is not liking that any more than I am. Now let's come back to the notion of just the reciprocal tariffs being a reflection of your trade position. You know, one MIT professor was very keen in pointing out that a surplus or a deficit doesn't necessarily mean a good or a bad thing. I run very much a surplus position with my employer. I provide my services and I receive compensation in return. When it comes to my local grocer, I run a very severe deficit, and Savon will attest to that. I give them my cash in exchange for their goods and services. Now, am I better off from an economic perspective by cutting out the middleman, balancing that trade, and going to work instead for my local grocer? You know, economically, I think it's in both of our best interest that that does not occur. Now, the market seems to be of a similar sentiment, that there's not a lot of sense and not a lot of positivity that can come from balancing those trade relations. And we saw that the day after the announcement was made. So one day out, April 3rd, this was Thursday, US industrials as represented by the Dow were down 4%, the broad market, the S&P down 4.8%, and the tech-heavy NASDAQ was leading the charge just down 6%. Now, that's led by the Magnificent Seven, who had wiped out $1 trillion in market cap by the time I'd finished my morning coffee. So if you've been heavy into the big tech play over the past little bit, you're probably not having a very good time. And that market, the NASDAQ, has actually just entered bear market territory as of this morning, where I'm coming to you on Friday. One thing to point out here, the VIX, that's a measure of volatility, sitting at about 39 at this point. Now, readings for that, I mean, that brings us back to about August of 2024. If we're looking at, a COVID volatility level, we're looking at about an 82. So absolutely volatility on the uptick, but manageable at this point in time, not something we haven't not seen anyways in our recent trading history. Now, as I said, I'm coming to you on Friday, April 4th, 8:17 in the morning. This is what I'm looking at. The industrials continue to be down about 2.6%. Broad market S&P down 3.2%. Tech-heavy NASDAQ still continuing its slide down 3.3%, with volatility hanging in there. So not a pleasant day. There's a lot of red on the board, admittedly. And red doesn't always have to be a bad thing to see on the board. So where is it a good thing? That's in the bond environment. So red on the board in this case means that yields are falling down. There's an expectation that rates in the economy are going to have to be cut to accommodate some slump. And that is the fear that's permeating right now, is that there's perhaps an elevated risk of recession. Now, bond yields going down are a positive for bond prices. So it's a very good time to have been a bond holder coming into this. And if this downturn does persist, it's almost going to force the hand of the central banks into cutting rates further. These bonds are also dry powder in your portfolio. They are the first place that we would go for access to cash in the event that this slide continued and we needed to go shopping for some stocks that were on sale. Plenty of liquidity in our Serenity portfolios, just to say. Now, I don't want to downplay that this is not a serious event. This is the largest trade disruption that we have seen since the 1930s. What we are going to say is that we did come in a really solid and prepared position. So if we're looking to even a standard growth portfolio, you've got about a small 2% cash buffer there, but about 22% in fixed income, or these bonds that we were talking about. So right off the bat, you've got almost a quarter of the portfolio, $1 in $4 you have with us, that is there ready to be harnessed for discount shopping should the need present. We've also got over here your alternative investments. So that's 10% of everybody's portfolio, regardless of what level of risk tolerance you're at this point in time. That's your traditional inflation hedges. It's been your gold, it's been your copper, it's been your commodities and natural resources, the stuff that is supposed to be there to perform well in an inflationary environment. Now, if the worry becomes more recession than inflation at this stage, we're more than willing to tap into that for additional liquidity to be able to better support our ability to harness downturn conditions. These are the markets where the money is made. That's a combined effort. It's not just us. We're here, we've positioned, we built this up over the course of 3 years at this point. But the other 50% of the equation is how our clients are going to be able to navigate this. So here's the game plan for that moving forward. We're going to be maintaining this open line of communication for as long as this market outlook persists, as long as the volatility becomes elevated. We will be here keeping updates in streaming as they roll. We're also prepared to add in emergency asset mix committee meetings to exactly make the changes that we were just discussing here, be able to harness our fixed income holdings that we're coming into this heavy with, and use that to purchase equities, stocks at the end of the day at a discount. If we're talking about the US market right now, we're sitting at about 19 times forward earnings from a valuation perspective. All that means is I will give you 19 times what your company is generating in earnings for one share of ownership in your company. We're looking for sales more so in a 16, 17 range. So yes, there is a possibility this downturn could continue. We're viewing that right now from a perspective that we would use that as an opportunity rather than a point to turtle up the portfolio. And we're coming in here with a lot of dry powder. As is Canada, as is the States. They've got a lot of room to cut rates, a lot of levers to pull to be able to stimulate the economy. There's still a lot of backstops in place, and we're seeing in the credit environment that liquidity is still good, which was not the case in 2020, and therefore we should be able to have a better and more moderated response. But we're here if the opportunities present. What we ask for is the acknowledgement, the fortitude in knowing that the way that we've constructed your portfolio and its strategy to support your financial plan was planned for. It was markets like these that we had in mind when we were deciding how to position the portfolio to support the objectives you've given us. It's been a great past 2 years. We've appreciated the good times while they were here. But once more, this is the market where the money is made, and we don't want to be in a position of being a forced seller. Our clients are not at this point in time, And we don't want to see a shakeout occur. We don't want to see that transfer of wealth from the retail sector that gets spooked with the downturn over to the ones that have been prepping for this and had cash on the sidelines. We will make it through. We thank you for your trust. The track record is on our side for getting our clients through environments such as this every couple of years now anyways. And at this point, all we can do is keep you informed, keep the plan on track, and we will be in touch as much as possible in this forum as we navigate. Thank you.